We have a question here from Asanka asking what a reasonable return on investment we can expect from trading, and if he is currently making large amounts of profits, whether that is unusual and whether he should be, or whether he's busy gambling if that is the case. Thanks for the question, Asanka. I think it's a very, very important question to ask. This is a question that we frequently get asked, and the answer is a tricky one because there are so many variables that can affect the performance and return on investment. But before we get into that, let's start by looking at a reasonable return on investment or a reasonable growth in your account. What is considered reasonable? Now, retail traders often have an unrealistic expectation for the type of returns they can achieve in trading, and it's not their fault. It's all the false advertising of private jets and guys sitting in Lamborghinis out there that paint a very fake and false narrative of what trading is really like. Now, some of these scammers will promise endless wealth and brag with fake accounts and fake records and fake money just to lure people into buying their signals or buying their, never before seen trading course or education or whatever. But it's all bogus. You know, what it does is basically just place a very unrealistic expectation on what can actually be achieved in trading. Let's take a look at the industry. If you take an investment of $1,000 or $5,000 and you put that into an investment fund or a bank, what do you think you are going to realistically make on that amount per year? If you take something like the S&P 500, now the S&P 500 is a key benchmark. They take or they reckon that the average annual return of the S&P 500 is about 12% per year. Now, remember, the S&P is usually used as an overall benchmark of overall stock market performance, and many funds base their returns, based on how they performed when looking at something like the S&P. Now, there's a very useful article from The Balance that we can quickly take a look at as well that looks at the past 15 years in terms of performances, and we can see here that something like US large cap stocks over the last 15 years returned about 8% per year. Even less would be mid cap, small caps, and then we go down to bonds, etc. So, this paints a very different picture compared to what some of these scammers out there would want you to believe. Now, let me show you these returns. Now, this fund, I haven't included the name here because it's a fund where I personally have my retirement savings in. And that particular investment fund has very different, have basically compared their performance versus other funds in the industry. And the top one is the fund where I have my retirement savings in. And you can see that has an annualized return of 16.4%, which I think is really, really good compared to any of the others, especially compared to the benchmark of the S&P. That's only 12% per year, right? Now, there are, of course, other funds that are the exception to this rule. I know of some funds that have an annualized return of over 30%, some 60%, and some of them, a select few, even raking in over 100% per year. Now, they are definitely the exception and not the rule, of course, right? These are some of the best of the best of the best, where your minimum, and I mean your minimum investment amount, will start at $100,000 upwards. Right now, let's go back to these investment funds and these results, and let's take that top performing one, that 16.4% annualized return. That is over the last 19 years, if I recall correctly. Now, that is vastly different from some of the expectations out there in the industry that aims to make about this amount every month. It's not impossible. It's definitely possible to make these amounts per month, but you're probably only going to do that by using a lot of leverage. And the unfortunate thing about leverage is leverage goes both ways. Yes, you can make a lot of money in a short space of time with leverage, but you can also lose a lot of money in a short space of time by using too much leverage. So as a retail trader, if you are making, let's say, above 16.4%, if you're making 17% annualized, you are basically outperforming some of the very best investment funds in the world, which is a major accomplishment, I would say. But again, it comes down to your leverage. If you make 20% per month, that's awesome. But if you are risking, 40% of your capital to make that 20% per month, then that is eventually going to be, it's going to end badly once the statistics starts playing out. So when someone asks me what they can look to make as an individual investor or trader, it really depends on so many factors, right? So how much are you willing to risk in your capital? How much time do you have available realistically to trade and invest? What are your goals? If your goals are just to make a little bit money on the side, then you are probably going to want to use more leverage than a trader like me, because a return of, let's say, 30% for me is an amazing result if you have it as a consistent track record per year. But if you're trading with a, let's say, a $10,000 account and you're making 30%, it's not really that attractive because you're only going to making $3,000 for that year. But I would much rather do it that way, much rather do it slow and steady and build it up over time than trying to push and rush it and stand a chance of losing that hard-earned capital, um, because you're trying to leverage up when you shouldn't. So if I get anything over 20% in a year, I'm basically outperforming some of the best investment funds in the world. And more so, if I'm consistently doing it year in and year out, then that compounding effect will pay dividends in many more ways than one. Now, the other thing I would add here is that you need to also risk only what you can afford to lose. I can't stress this point enough. I have a personal trading account, and my aim with that personal account is to outperform all my other investments. So I want to outperform my retirement investments that's invested in a fund. I want to outperform my tax-free savings accounts. I want to outperform all of them that I think provide okay returns. But my aim is to always outperform them. And just because I'm outperforming them doesn't mean that I'm going to go and take all of that retirement money and trade with it. That would be way too risky from a portfolio perspective, because what you want to do with a portfolio, you want to run a diversified one that never puts all of your eggs in one basket. So my aim isn't, trying to make a quick buck by piling everything together and seeing how much I can make out of it. The goal is completely different from that. So I would say if you're making, huge amounts of profits right now, that's awesome and well done on that. But, if those profits, if they're seeming too large, you might be risking a tad too much. So, just be careful not to overexpose your account. Don't over leverage in any way, and make sure that you're always following good and proper risk management principles. If you are making, um, 20% annualized returns, or let's say you're making 100% per year, and you're doing it with a drawdown of 8 or 10%, you're absolutely smashing it, and that's awesome. But make sure to check that drawdown. Don't, if you're making 100% returns a year but your drawdown is 50%, then that's not that good. So just make sure to always keep that risk management in control. Don't try to get rich quick, so to speak. Make sure that you're keeping your funds in control, keeping your funds safe. At the end of the day, yes, we're doing this to make a profit, but we also want to preserve that capital, which is a big point to always remember. So I hope that helps. Any other questions, don't hesitate to let us know.